for joining us for today's webinar, Charitable Gift Annuities, Misconceptions and Opportunities. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and welcome everybody. Today's webinar is on a deceptively simple topic, charitable gift annuities. I'm going to refer to them as CGAs several times during today's presentation. And for the next 15 minutes, we're going to talk about CGAs. At Advanced Underwriting Consultants, we get asked about charitable gift annuities all the time. And in our experience, it's primarily from less experienced agents who want to sell the annuity part of a charitable gift annuity. And we're going to talk a little bit about how CGAs work today. We're going to talk about the limited opportunity to sell an annuity in connection with a CGA. It's going to be the exception rather than the rule. But the real chance for the life insurance professional to sell something is to serve your client who's considering a planned gift and to serve them by helping to take care of family because a substantial gift is going to go to charity. So let's go ahead and get started. So first of all, let's talk about planned gifts, and let's talk about what is a planned gift in the context of charitable giving. It's a charitable gift that is not just writing a check right now to charity. That's from our perspective what a planned gift is. One example of a planned gift is a qualified charitable distribution. As many of you are aware, the rules changed in the last few years. Congress and the President got together and said that this technique is available permanently, and that is that if you're older than 70 and a half and you've got an IRA balance, you can make a transfer directly from the IRA to a charitable organization, and it won't be considered a taxable distribution at all. And so that's a good thing. It's not the same as writing a check for the charity. It requires more thought and planning, hence it is a planned gift, but it is a very efficient way to decide to take care of a charity if you've got a client who is older than 70 and a half with a significant IRA balance. What are some other examples of planned gifts? Well, charitable trusts, charitable remainder trust, charitable lead trust. What is a charitable remainder trust? Well, a charitable remainder trust involves making a gift to charity and retaining an income stream for a period of years or for the rest of the donor's life. That's typically how they're put together. And the income stream can either be a fixed income stream, that's a charitable remainder annuity trust, or it can be based on the annual value of the trust's asset. That's a charitable remainder unit trust. In either case, the charitable deduction that the donor gets, and the IRS says the donor can take a charitable deduction with a properly structured charitable remainder trust. The charitable deduction is based on the value of what is given away, the fair market value of what is given away, minus the present value of the income stream that the donor keeps. So it's not a charitable deduction just based on the fair market value of the asset. You got to subtract out the present value of the income stream. That's charitable remainder trust planning. And it's also possible to put together a charitable lead trust where the charity gets the income first and the family gets whatever is left at the end. That has very different income tax consequences, and I'm not going to go into those today because we have a limited amount of time. What are the other ways to make planned gifts? Donor advised funds, family foundations, and testamentary gifts to charity at death. Most of those types of techniques either involve the heavy-duty involvement of a lawyer, or they may involve conversations between the donor and the charity to pull off in the way that the donor wants. But those are all examples of planned gifts. So let's talk about charitable gift annuities, and let's talk about the contrast between a charitable gift annuity and a charitable remainder trust. So a charitable remainder trust requires a lawyer to be involved. You got to have a lawyer put together the trust, and you probably have to have professionals, lawyer or accountant or both, to help administer the trust along the way to make sure that the rules of the trust are followed by the trustee of the trust. So you've got the hassle factor of having to go to a lawyer. You've got to have a lawyer and an accountant perhaps involved in the administration along the way. And in a lot of cases, you're going to consider hiring a professional trustee because you don't want to screw it up and endanger what has happened charity-wise, nor do you want the charitable beneficiary of the trust to get ticked off and to sue the trustee for not having done things right. And so there's a fair amount of cost and hassle associated with putting together a charitable remainder trust. So the charitable gift annuity is a reasonable alternative for a donor to consider if the donor likes the idea of a charitable remainder trust, but doesn't want to put up with the hassle of putting one together or administering it along the way. So a charitable gift annuity, like a charitable remainder trust, is designed to, the charity accepts a gift from the donor and promises to pay back money to the donor, an income stream, in a lot of cases for the rest of the donor's life. And so the charity makes a promise to pay that later on, but the charity gets to keep and use the gift up front in a way that the charity is in complete control of. Now, there's an American Council on Gift Annuities, and you can look online and you can see the definition that we've got here on the slide. A charitable gift annuity is a contract under which the charity, in return for a transfer of cash or appreciated asset, agrees to pay a fixed amount of money to one or two individuals for their lifetime. So it is a charitable gift, and in exchange for the charitable gift, the charity agrees to pay to the donor an income stream, and hence the name charitable gift annuity. The payments back to the donor are annuity-style payments. Now, the person who receives the payments is called the annuitant or the beneficiary. The payments are fixed and unchanged for the term of the contract. So it's not like a unit trust, it's like an annuity trust. Portion of the payments are a partial tax-free or return of the donor's gift, partly taxable depending on the nature of the gift. Again, I'm not going to get into that in a lot of detail. And they are spread in equal payments over the life expectancy of the annuitants. That's how a charitable gift annuity works. So what are some of the differences between the charitable gift annuity and a charitable remainder trust? Well, the main difference from our perspective is that the contributed property is given irrevocably and becomes part of the charity's assets up front. And the payments that the charity agrees to make, the income payments back to the donor, are just a general obligation of the charity. The donor has lost control of the underlying asset. So unlike a charitable remainder trust that way, the asset goes to the charity immediately, and the charity makes an unsecured promise to pay back the donor. Now, the organization that advises charities on gift annuities says that in a perfect world, the charity's income stream that it pays back to the donor should be targeted to be worth about half of what the initial gift is worth. And so if I make a gift to charity of $1 million in exchange for a charitable gift annuity, in a perfect world, the income stream that I get back for the rest of my life should be worth $500,000. Now, that's not a hard and fast number. That's simply a recommendation. It is possible for the donor and the charity to negotiate over the amount of the income stream for the rest of the donor's life. But in any event, this is the suggested target for charities that do support charitable gift annuities. What are the tax consequences? They're like a charitable remainder trust. The tax deduction is based on the fair market value of the gift minus the present value of the income stream. There's an example there on the slide. If John makes a gift of $500,000 in cash, the charity promises to pay John an annual income of $22,000 a year in exchange for his gift. Since John's 60, if you look at the IRS interest rate tables, John's life expectancy, the present value of the income stream is about $350,000, and his actual charitable income tax deduction, if he itemizes and otherwise qualifies for the charitable deduction, is $150,000 in that particular example. So why would somebody choose a charitable remainder trust or charitable instead of a charitable gift annuity? It has to do with control. Charitable remainder trusts and charitable gifts annuities can both be attractive targets with appreciated stock. The deduction is based on the full fair market value of the appreciated stock minus the value of the income stream. But the difference is that a charitable gift annuity requires a whole lot less attorney work and cost. In fact, you can make a gift and get back a charitable gift annuity to a charity without getting an attorney involved at all. Now, it's probably a good idea for your client to talk to their attorney to figure out how the CGA is going to interface with the rest of the client's estate plan. But the fact that it doesn't require a lawyer, doesn't require a hassle, makes a charitable gift annuity fairly attractive to some clients, particularly those who are making smaller gifts than they might otherwise make in a charitable remainder trust. CGAs are less flexible from a design perspective. CRTs can be designed, as we talked about earlier, to pay out a unit trust kind of income stream, which is based on the annual value of the trust. CGAs are a fixed income stream. The donor in a CRT, a charitable remainder trust, has the ability to retain some control over the assets in the trust, particularly if the donor is the trustee, which is allowed. With a charitable gift annuity, it's the charity that gets to decide what to do with the donated asset, and the promise to pay is unsecured. And the big thing, from my perspective about charitable gift annuities is that if the charity runs out of money, the donor may be stuck. The donor may not get the income stream that the charity has in mind. And so there's an actual case that's referenced there National Heritage Foundation filed for bankruptcy protection in 2009, and the ability of the gift annuity recipients was potentially at risk. It's uncertain exactly how that played out, but that's always a danger with a charitable gift annuity. If you're dealing with a charity that doesn't have a long track record and doesn't have strong financials, it may be that the donor won't get the expected income stream with a charitable gift annuity. There's more control with a charitable remainder trust. And so we get a lot of calls from life insurance professionals saying, well, I want to sell an annuity because my client's interested in a charitable gift annuity. And the only kind of annuity that makes any real sense is an immediate annuity, because it would provide the income payment to the donor. The practical problem is that the agent wants to sell the immediate annuity to the donor, but that's not how it works. It's the charity's obligation to pay the income stream, and the charity's got to make the payment. It's got to be an unsecured promise to pay to make every part of the CGA work the way that we expect. And so that since that's true, it would have to be the charity that would decide, after receiving the gift from the donor, that the charity would decide to ensure its obligation to pay the donor the income stream by buying an immediate annuity, essentially reinsuring its obligation. And it would be an immediate annuity that would be under the charity's control, and it would be the charity's decision to make the purchase. And in the real world, that doesn't happen very often. And so it's unlikely that a charity would make such a purchase to reinsure its obligation to pay an income stream to the donor. So what are the opportunities for the life insurance professional? I think there are two. The first is that it makes sense for the life insurance professional to know something about charitable gift annuities, so that the life insurance gains credibility with the client and is able to serve the client better. That's the kind of the soft benefit for knowing something about CGAs. The more direct benefit is the wealth replacement idea. If you've worked in the charitable market before, you know that in conjunction with a charitable remainder trust, often we sell life insurance, and sometimes life insurance owned by an irrevocable life insurance trust, as a wealth replacement tool with regard to charitable remainder trusts. With a charitable remainder trust, if I give $1 million to the charitable remainder trust and keep an income stream, that's great. But the downside is whatever's left in that remainder trust at the end of its term, a lot of times it's when I die, goes to charity. It doesn't go to my family. And so I might decide to buy $1 million life insurance policy to replace the value of what it is that's going to go to charity from the charitable remainder trust. With a charitable gift annuity, the idea is the same. If I make a gift to charity and get an annuity income stream in exchange for it, I might decide to use some or all of that income from the charitable gift annuity to buy life insurance to replace the value for my family. I might use an irrevocable trust, but because a charitable gift annuity is easier than a charitable remainder trust, I might not be using a lawyer at all, might not have an estate tax problem, and so I might own the life insurance directly and name my family as beneficiary so that the value of that wealth is replaced. So if you've got a client that's charitably minded, CGAs are easy and cost-efficient way to help them meet their charitable goals. It's not a fit for everybody, but you got to know about them in order to be able to talk about them competently to your client. You've got a client that's thinking about a charitable remainder trust but doesn't like the idea of having to deal with a lawyer, an accountant long term. I think it makes sense to talk to them about CGAs. I think if you're able to talk about them competently, it puts you in a better position to serve your client, and you've also got a direct ability to sell your client life insurance to replace the value of the asset that is given to charity. And I would like to thank you again for joining our conversation this morning on charitable gift annuities. And at this point, I'm going to turn it back over to Jennifer. Jennifer.
Thanks, Lennis. And thanks again for joining us. And join us next month on November 1st for beneficiary designations after divorce. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.